Hey, good morning. Hope you're well. This is Mayor Vilensky with Driving Markets. Just a little upfront warning that anything I say or suggest on this particular video is only an opinion. It's not that you should go and do this, you should go and do that, etc., etc. So just be very, very clear so I don't get myself into trouble. As follows. So the markets came off last night in the US, and obviously European markets followed them. There's several reasons. Is number one, there's worried about the pandemic. Number two, the retail sales in the States came in much lower than expected. Number three, you've got concerns of economic recovery. People are not buying what they used to buy, etc., etc. Delivery times are taking longer. However, that's all great. The main reason they came off, in my opinion, is that the markets themselves have reached all-time high. Now, when markets reach all-time high, they reach all-time high not for one day, not for 2 days, it's day after day after day, they're surpassing the all-time highs, then, and there has not been any downward spiral, any downward correction, then you're going to get profit taking, at least minimum, you're going to get profit taking without the justification of the factors of retail sales or economy not recovery or pandemic. It's mainly profit taking. And when you come to trade, you should look at trading within the range of your day trader. If you're a swing trader or scalper, you should look within the range. Where has that market been within the range? So for example, if you've got a 40, 50 point move on a particular asset class, whether it's FX or indices or even shares, and you know that's the top of the range or the bottom of the range, then if you're a trader, you should be trading within that range. In other words, looking to take a few points out of the range that is traded. Never be greedy and start saying I want to take the whole 50-point movement or the whole 300-point movement if it's a Dow. Take within the trading range and look to take percentages per day. What does that mean, percentages per day? Look at what is your percentage return on your total investment, and if it's 1% or 2% a day, then you're doing fantastic. Because if you make 1% or 2% a day, and you look at the end of the month, end of the year, you'll be making in the 10s, 20s, and maybe hundreds of percent a year. So therefore, you look at the percentage return per day. Don't look at the absolute capital or absolute money that you've made, because if you look at the absolute money that you made, it might only be $3 or $10 or $20 or 20 euros, and you might say, oh, it's not worth it. What can I do with that money? That's not the way to trade. You look at the percentage return. That's regarding trading. So I would suggest that you look at the markets at the moment. There might be further downward spiral and profit taking. Once a break has happened, then it really is important to see what happens over the next 2 to 3 days. Be very cautious. Use small amounts. If you make your money for the day, stop trading. That's enough. You don't need to trade all day every day. Trade once or twice is more than sufficient. If you need any further information, you can contact me on LinkedIn, or you can send me a WhatsApp if you have my number. Maybe comment or reply. I hope this video is of value to you. I would love some feedback, so anyone who does have my details, please give me some feedback, what you think on the production, etc., etc. Thank you very much. Wish you well. Have a good day. Success in your trading. Let me just turn off this phone. Thank you very much. All the best.